Wednesday. We are coming to you live with the Investing Education Academy. And today, many of you know there was an announcement from Federal Reserve or an update on what's happening with the interest rates or the inflationary environment, or the Fed giving us kind of their thoughts on what's to come. And what has already come, we already know, has been chaos in the stock market, and everybody thinks because it's so chaotic, they're running away, run to the hills. And that's not always the best thing to do, but it's not always wrong either. So we're going to talk about what this announcement meant, or the meeting today meant, will mean for your portfolios. With that being said, also wanted to say thank you to everybody who recently joined Investing in Education Academy. The community is continuing to grow as a result of some of the things Leon and I have been working on. We are going to start going live more frequently inside of the membership platform, so we can bring the most value to those who are in the platform. And also, we feel like it's necessary for us to be more visible during times of volatility in the market, such as what we're occurring right now. So Leon's going to tell you why we chose this topic, and I'm going to do a little bit of housekeeping.
Yeah, so today's Fed Day. Happy Fed Day, everybody. What this means is like Brent said, the market has been absolutely putrid the first 3 weeks of this year. Through, I believe, Monday or yesterday, it was the worst start. It was the worst start for any year in the stock market in the history of markets. So anybody who's in the market right now, you're experiencing something that's never been experienced before, which is the market has been insanely volatile. And it was down the first 3 weeks of January, the most it's ever been in the history of the market. So those who are still in it, still riding through it, commend you. This is new for Brent now too, right? Like we were talking earlier today, our accounts have been battered, and doesn't feel good. So just know that we are in the same exact boat as everybody else, because we are heavy in tech. We were in some of the more speculative tech that we got out of towards the end of last year, but still took some losses in quite a few of those positions. But we're pretty comfortable with our portfolios now. Still taking a hit, but we're definitely focusing more on companies that have solid profits and solid revenues.
Leon, real quick, let me jump in on that. For those of you all who think that Leon and I waved some magic wand and all of a sudden we're impervious to anything that happens in the markets that relates to volatility, we're not. But then I want to tell you something even on a completely different level. For those of you all who think we don't have emotions around the market, that's not accurate either. You want to know why Leon and I were talking earlier today? Because we were like, yo, what is happening? What's the play? And we were figuring out, like, what must our community need in a time like this? Because we know what we need. So we were like, okay. We're going to make some adjustments to be there for you all. But, more importantly, I want you all to know we're not isolated from anything happening. Now, I will say this, though. I do want to say this. If you are in the Investing Education Academy community, you know that Leon and I have been talking about this since probably October, September last year. And we've been saying just 2022 was going to look different. We've been saying that for a while.
And since November, when the Fed announced all this, we've been saying get out of those tech stocks, get out of those low quality tech stocks, move to quality companies.
And not only that, we've been posting for those of you all who are in our platform, we've been posting what we've been buying and selling. And so you all can see that we've had a mass exodus of some of these more speculative investments. And just, again, level set, this is not going to go away tomorrow. No, this environment is not just changing because we hope it will. So I didn't mean to interrupt you, but I just wanted everybody to know that we're going through it too. And even though we're going through it, we're adjusting our portfolios, and some of the language has changed from where we were in 2020. And this is why you need to be in communities. This is why you need to be, again, we even say it all the time. We don't even care if it's us. But when you're not in a community, you're in your head, and you start to literally think of the worst case scenarios, and you're going to make a panic decision, and you're going to regret it, not now, in 3 years. in 3 years, you're going to regret some of the moves you're making today if you don't make good moves. So,
yeah, and what we were talking about earlier also was when Brent and I were talking earlier, it was a bit of a venting session as well. Like we were just like, "Yo, what the hell is this?" Because again, this is the most volatile market. And think about it. Think about how crazy it is. Where we are right now today, the first 3 weeks of the year is worse than COVID. Because this is the worst 3 week start to the stock market in the history. Now, of course, COVID wasn't the beginning of the year, but just think about that. The worst start ever in the history of the market. It's actually comparable to COVID, not necessarily worse, but it's comparable to the COVID drop. So it's been rough. Like I mean, like I said, we were talking earlier. We were. It was a venting session. We were like, okay, what are we gonna do? We were kind of talking through, but again, we were talking through to each other because again, that you need that community. You need to get out of your own head. And then we try to bring that to the IA committee. So, all right. So today was Fed day, right? Fed met yesterday and today. Today they come out with their announcement. So what their announcement was, first point was that they did not raise rates today. Nobody expected that. But what everyone was looking for was what were they going to do in the future? So Jerome Powell, head of the Fed, they basically came out and said in their kind of their notes, said that yes, they are committed to raising rates. So before it was like, oh, they're going to do it, are they going to do it? They haven't really said. They said today they're going to raise rates. They didn't say when yet, but everybody pretty much knows it's going to be March, because remember we've been talking about this thing called taper since November, and that's going to end in March. So the expectation is that they're going to then raise rates also in March. So the first rate hike we're looking for is most likely going to be March of this year. And then what everyone's thinking is that, so they're talking about doing 3 rate hikes this year, and each one would be a 0.25% hike. So right now rates are basically at zero, roughly. They're between 0 and 0.25. So they'll go anywhere from 0.25 to 0.50 once this rate hike happens in March. And then they're saying every other quarter after that, they'll raise it again. So the thought is that they'll raise 3 times this year, 0.25%. So by the end of the year, we're looking at rate at least, and yeah, 0.75%. But I also want to make another point. This is a big point we're talking about today. Is that and I kind of educated myself on this today too. Is that so the rate we're talking about that the Fed is raising? It's called the Fed funds rate, but none of us know what that means, right? What we know about is something called the prime rate.
The prime,
right? So everyone's heard of the prime rate. Like your credit card typically say like, okay, your rate's going to be 1% over prime, right? So when the Fed raises rates, we the general consumer are affected by that prime rate. And what's affected by prime rates? And I was like, let me look that up. So I took some notes. So for us, again, this how this rate increase is going to affect us individually. So prime rate affects things like credit cards, home equity loans, and personal loans, and any loan that has a variable rate. So I'll say it again: credit cards, home equity loans, personal loans, or any type of debt that has a variable rate. I can never say that word. So those are type of loans that prime affects. So for us as consumers, when the Fed raises their what's called their Fed funds rate, for us we want to look at it, how is it going to affect the prime rate. Now here's the messed up part, right? So everything I just listed off are things that are ways that we can be hurt by money, by these assets. They're not even assets, these liabilities. Credit cards are debt, home equity loans are debt, and personal loans are debt. Things like that are debt, right? So things we take out that charge us interests. That's what the prime rate affects. Look what it does not affect: savings accounts, certificates of deposits or CDs, money market accounts. So think about that. The Fed is raising rates, right? And it's gonna be detrimental to us because a lot of us have debt in credit cards, home equity loans, personal loans, things like that. But things that we can actually make money from, we're not going to see any benefit from. So that, remember, Brent and I before were saying you may or may not see your savings account rate rise. And typically, if you do it, it comes really, really late, like years later. But what I found out today is that only time they do that is because they're really just trying to draw in more customers, right? So if right now Bank of America is charging 0.05% and they want to draw in more customers, they may raise that to 0.07%, right? Not no big deal, but they can say it's higher. But there's no reason for them to raise rates because the rate that the Fed is raising, does not affect savings accounts, CDs, or money market accounts. So that's why we typically will not see. We're like, oh, they're going to raise rates, it's not going to. We're not going to be paid off from it, right? Now think about this. Also, here's the reason why. So credit card. Let's take credit cards, right? Banks issue credit cards. That's going to raise credit cards and loans are the biggest things. So that's going to raise their revenue, right? So as these rates rise, credit card interest rates are going to go up, and so are loans. So that's going to bring in more revenue for banks. Now, why would the bank turn around and then pay us a higher rate on our savings account, which is money out the door? They're not going to do that, right? And they don't have to, because the Fed fund rate or prime rate does not affect savings, CDs, or money market accounts. So this raising of rates is actually in some ways going to hurt us, because it's going to raise rates on things where we take out debt, and it's going to do nothing for the things where we can make money, things like savings accounts, CDs, or money market accounts.
And Leon,
so I thought that was a really big distinction. I found earlier. Yeah, go ahead.
So for you all thinking like, well, what does that mean? It means that the house that you may want to purchase costs more. It means that the car you may want to purchase costs more. It means that the money you may want to, I'm trying to not to use the word the money that you want to buy, but the money that you want to borrow is more expensive. And what does that not mean? That means that you're necessarily not going to get a financial windfall on the savings account side, or it's called traditional investments from banking institutions, as a result of this. So you're not earning more money in theory. It means, again, like I said, some banks may want to just give promotional interest away or for a temporary time, but you're not going to find cheaper assets that you have to purchase. You're not going to find cheaper money as a result. Money is going to be more expensive. So
and the big thing to me is that there's no benefit for us as far as savers in a rate hike, right? So again, you think that, rates are going up, I'm gonna get a better rate on my checking account, savings account. No, you're not. Because as I said, the Fed fund rate, what the Fed is raising, for us, it affects the prime rate. Prime rate is not affected. The prime rate does not affect savings accounts, CDs, or money market accounts. So things that we can make money off of those rates are not going to go up, because banks they're not going to pay out more money to us when they're about to make a windfall from huge increases in credit card rates and loan rates, right? So that's why you never really see rates rise in your savings account and your checking account, because banks don't have to, right? Those rates are not tied to the Fed fund rate or the prime rate. So just FYI on that. So back to the Fed thing now. So I was that was actually new to me today. I just when I was doing the research today, I found all that information out. So I'm going to bring that to y'all. But the other portion of this is that, so a couple weeks ago when they talked, everyone thought the Fed was too hawkish, right? When hawkish just means that everyone's here, they're going to raise rates really, really fast and then kill the economy. So one thing they did come out today and said that, well, they came out late, I should say, with it. They did put out a statement, but basically, this is going to get a little wonky, but I'm going to try to make it light. The Fed's balance sheet is where all those bonds they've been buying are sitting. When the Fed sells those off, that in turn raises rates on the long end. So just bear with me. It raised rates on the long end. The stock market was having a tizzy, because they were talking about they thought they were going to raise rates and at the same time start selling the bonds on the balance sheet, which is going to raise, which basically, think of it it's like a double whammy on interest rates that was going to shoot them higher. Well, they came out today and said that the balance sheet portion of it, they're not really going to tackle right away. They're just going to their main ammo to slow inflation is going to be that Fed fund rate, or for us is that prime rate. So the Wall Street took that as, okay, they're not going to use a double barrel at this. They're going to focus on raising just the Fed funds rate or the prime rate, and kind of leave the balance sheet issue, for months down the line. So Wall Street saw that as a good thing, and didn't sell off as much, because if anybody watched the market today, we were up huge this morning, huge. Like I was like, woohoo! And then so I'm watching the Fed and I'm watching the market just tick down. So I ended up roughly flat on the day in my account, which I was happy for, because I was telling Brent earlier, right now I don't even care if I'm making any money. I just don't want it to go down anymore. So so thankfully, when they came out and said, Fed said what they said, after the Fed came out and said that they're not going to deal with the balance sheet issue right now, the market loved that, because that's not a double barrel at this thing. They're just going to focus on the one barrel, which is the Fed funds rate or the prime rate. So that's the news of the day. That came out of the big Fed day today. But it's still going to be rocky and topsy-turvy. I mean, we were up huge today, then we were down huge. Well, not huge, we were up huge, down moderately, and then kind of came back and I finished about flat, which was kind of how the market finished. So get used to this until all these trillions of dollars, settle, get this thing settled out, and figure out where they're going to put their money. It's going to be a rocky 2022. But as as we've been saying, if you can buy these quality, either tech or industrial or defensive, whatever you're into, retail, quality comes with strong profits and strong revenues. Looking 3-5 years out, we'll be fine.
Yeah. And if you don't know what to look for, when we, some of you all are listening to this going, well, we don't know what to look for. Join Investing Education Academy, because we talk about it inside the platform. And we also discuss, when you're reading information about these stocks, we've done it in some of our lives. So if you want to go back and find it, you can. But we definitely suggest, if you're sitting there right now going, you know what, I've been stressing over this account, I do want to learn more, I do want to be in a community, make today the day you actually join Investing Education Academy, because 2022 and going into 2023 is going to be a very different environment. And I think, honestly, because of the political environment, when we get to 2024, it's going to be another earth-shaking type of year for the market. So,
that's an election year. That's a presidential election year.
That's what I'm saying.
Yeah.
Mm-hmm. It's make today the day. If you've been thinking about it, it's going to be those moments where you need a team. You need a very strong team to pull you off the ledge. And so, Leon, anything you have before we wrap up?
No, that was it. Just continue to focus. If you're in the market buying, continue to focus on companies that are making money, printing money. And I don't just mean like one quarter. Like, you want to find companies that have made money the last two. Like I always say, look at the 3-year average of their profits. So, for me, I want to at least see a 3-year average growth of 10-20%, something like that. But you want to see a company that's been profiting, sustained profitability over the last at least minimum 3 years. That's to me, that's the best way to look at it. And stay away from those non-profitable, very speculative SPAC or tech companies.
Yeah, and I received a phone call from a couple people who had recently read magazines and just blindly purchased what they read about in the magazine. This is not a blanket statement. So for anybody who's editor or owns a magazine, not necessarily saying you, I'm just saying from my experience, I'm not even pulling IEA into this one, Leon. From my experience, a lot of time when you read articles in magazines, you're trying to buy on the news of glamour. Like, it's a paid ad, which you read as an article, but it's a paid article. They paid to get that article into the newspaper or magazine. So number one, that means that they're probably trying to get people to buy the stock. Two, you normally don't know when it's a paid article that you're reading versus an article that the magazine just chose to pick up. And when you make those selections just simply based on that, there is no substantive support behind your reason for buying it. Besides, you read it, you hope the magazine was reputable, and you decided to take a chance. That's the wrong way to invest in this environment. So if you are reading a magazine, if you're reading through something that's not primarily focused on financials all the time, give it greater scrutiny. Absolutely give it greater scrutiny. And I'm stuttering because I'm trying to stay away from naming names, but I want to so bad. But yes, you know who you are, magazines. You know who you are, newspapers. And some of the financial papers and news magazines that you do read also have paid articles in them, but they're blended in with the other articles that they decided to really truly pick up. So again, you just don't know which ones are really a well-placed advertisement and legitimate news.
And this is why we would say you got to do your research. I don't care if you're reading Forbes, Wall Street Journal, Washington Post, whatever. Like Brent said, sometimes there are agendas behind these articles. Sometimes not. Sometimes the editors find it to be information, useful information. But again, just even if they find it to be useful information, that still doesn't mean make it investable. So you always want to do your research, no matter what you're reading online or on print. Always got to do your research then, because it's your money. Can't blame anybody else if you buy a stock randomly and you lose money on it. It's all on you.
Yep. And then this volatile environment, if you're thinking, okay, I'm finally ready, I'm joining IEA, you can go to IEAnow.com to join, and just know that we have some new things coming, some glossy new stuff coming in the probably next 2 weeks. So we'll be sharing that with you all. And for everyone who wrote us a testimonial, everybody on Investing Education Academy in our Facebook group who wrote us a testimonial, thank you so much. And
Thank
for
you.
those of you all
Thank
who
you.
haven't seen some of these testimonials, you can actually go to Investing Education Academy, scroll through the feed. You will see some of these testimonials popping up. And we want to let you all know in what we're working on, we will absolutely be using those testimonials. So if you've been meaning to write us a testimonial, please feel free to go to investingeducationacademy.com. You can find the thread and leave your testimonial. It would be greatly appreciated. And other than that, we are done for today. We look forward to seeing you all next Wednesday. Again, thank you so much for all the support. Also, thank you for just giving us the grace to send us emails, to ask us things before just making crazy decisions out there. Some of you all have really, truly taken advantage of the platform and posted questions. And I can see there's a difference than what you probably would do if you were out there by yourself. So
definitely. Yep.
Everybody have a beautiful Wednesday.